This week, the market stayed locked on one story. The Middle East war is no longer just a headline risk. It is now a full market driver. The biggest pressure point is still the Strait of Hormuz. That route carries a huge share of global oil flows, so every new threat, every missile strike, and every military headline keeps traders on edge. At the start of the week, the market was focused on whether the US and its allies could reopen Hormuz. President Trump pushed for international support, warned allies, and kept talking about securing the route. But the problem is simple. Reopening Hormuz is not just about sending ships, it's about restoring confidence for insurers, shipping crews, and energy markets. And that confidence is still fragile. This week also brought more escalation. We saw strikes near Iran's coastal missile positions, attacks linked to energy infrastructure, fresh threats around South Pars, and Calm Island rising talk of possible US reinforcements. Even though some leaders try to calm markets by saying they want to avoid further energy strikes, traders know the conflict can still widen fast. This is why oil stayed elevated. WTI pulled back from the explosive highs, but it remained around the mid-90s. That tells you the war premium is still in the market. Yes, prices cooled from panic levels, but they are still far above where they were before this crisis escalated. Now, let's talk about what that means for currencies. The main theme this week was this: high oil keeps inflation risk alive, and that keeps central banks cautious. The Fed held rates steady and gave no strong signal that cuts are coming soon. That helped the US dollar stay firm, because traders are now thinking rates may stay higher for longer if energy prices keep inflation sticky. So, the dollar has been supported by two things. First, safe haven demand, and second, reduced rate cut expectations. On the other side, currencies linked to imported energy pressure remain vulnerable. That is especially important for Europe and Japan, where higher oil acts like a tax on growth. Gold told another interesting story this week. Instead of breaking higher again, it pulled back hard. That shows this is not a simple fear trade anymore. A stronger dollar and firmer yields have started competing with gold's safe haven appeal. So, the market is now balancing three forces: geopolitical fear, inflation risk from oil, and the interest rate response from central banks. That is the real story of this week. As long as Hormuz stays uncertain, volatility stays alive. Oil remains the key signal. If it pushes back towards triple digits and holds, expect more pressure on stocks, more support for the dollar, and more caution from central banks. Question for the audience: do you think this conflict stays contained and oil cools down? Or are markets still underpricing a bigger second wave of volatility? Drop your view in the comments.